Hello and welcome to Swissquote's Daily Market Talk. Today's episode will be a special edition where we will talk in detail about the Federal Reserve, which is preparing to call the end of an aggressive monetary policy tightening cycle with hope to offer the US economy the soft landing that it dreams of. The time has come, said the Fed President Jerome Powell when he took stage at the annual Jackson Hole meeting back on August 23rd. Remember? The time has come for policy to adjust and the direction of travel is clear, he said. So these words suggested that the Fed is preparing to cut its interest rates as inflation cooled and the labor market showed signs of weakness in the US. So, today will be the first day of the rest of our lives, the day when the US Federal Reserve will end the most aggressive monetary policy tightening cycle of its modern history. If we ignore the balance sheet side of the story, of course, the Fed is still expected to continue to let up to $25 billion in treasury securities and $35 billion in mortgage-backed securities to actually mature and roll off its balance sheet every month, but without any ambition whatsoever to return to pre-pandemic levels ever again, probably. But anyway, beyond the race and the balance sheet unwind, the Federal Reserve will also reveal its latest economic projections and also update its dot plot at this week's monetary policy meeting to give investors a hint, a roadmap regarding what to expect next. Now, it is very important actually to keep in mind that the Fed's dot plot is not rocket science and it doesn't always predict with precision what will happen next, right? It is just a tool for the Fed members to communicate what they think should happen with the data that they have in hand at time T. But their projections in no way bind them. On the contrary, they actually tend to be quite volatile and sometimes a bit emotional. Now, I'm saying this because, funnily, the March dot plot from the Fed had projected an average of 3 rate cuts of 25 basis points each, remember? Suggesting that rates could decrease to a midpoint of 4.60% by the end of this year. But in July, the average rate cut projection fell to only 1 interest rate cut, and that was due to heightened inflationary pressures in the US. And up until last week's inflation data from the US, remember, the markets were actually pricing in a 100 basis point cut from the Fed before this year ends still, and we have only 3 monetary policy meetings left. So, if you do the math, well, investors were thinking that the Federal Reserve would cut the interest rates at each of its remaining 3 monetary policy meetings of this year and will deliver 1 jumbo rate cut of 50 basis points in one of those meetings. And actually, some big banks analysts still continue to believe that the Fed could cut its interest rates by 100 basis points or more by the end of this year. Now, the expectation for today is quite mixed, to be honest with you. Consensus was that the Fed will start cutting its interest rates by 25 basis points today and not by 50 basis points until just last Friday. And it is now a coin toss, really, and even slightly higher for a 50 basis point cut. Now, even though the difference between the two, of 25 and 50 basis points, is not fundamentally dramatic, the message that the Federal Reserve will send to the market and to investors by opting for one or the other would be quite decisive. Because a 25 basis point cut would mean that the Fed is now done tightening its monetary policy because inflation is enough to let the policymakers believe that it will fall to the 2% monetary policy target in the medium to long run. Meanwhile, the cherry on top of it all, the economic growth in the US remain relatively strong and that there is no need whatsoever to exit tightening policy because things go smoothly according to the plan. I mean, a slowdown in the economic growth was what the Fed wanted to achieve to cool down the inflationary pressures in the first place, remember. And the slowdown in economic growth in the US hasn't been dramatic, mind you, because the latest GDP number from the US suggested that the US economy grew 3% in the second quarter of this year, and growth may have fallen to around 2% this quarter, but it is still a level which is far, far away from recession. So a 25 basis point cut would totally make sense this week. A 50 basis point cut, on the other hand, is meant for financial crisis, panic times, or a very severe economic meltdown, none of which are currently relevant. So, why on earth are there so many debates on whether the Fed should cut by 25 basis points or by 50 basis points in September and later on? It is because we have seen a few theoretical factors that actually led investors to think that the Fed may have fallen behind the curve, like the SAMS rule, for example. That was triggered back in July, remember, and suggested that, well, the US economy may already be in a recession. Investors then started to say that the Federal Reserve should have, well, actually start cutting its interest rates back in July already, and that the decision not to do so would force the Federal Reserve to cut its rates faster in the coming and the remaining meetings. Of course, the fact that the US headline inflation eased toward the 2.5% level in August, thanks to a significant slowdown that we saw in food and energy prices, also allows investors and obviously will allow the Federal Reserve to put more weight on the job side of the economic story rather than the inflation leg, as inflation is now believed to be under control. And yes, the labor market surprises have been quite on the negative side of the game lately, and you can see that on Bloomberg Labor Surprise Index. But if you take a breather and just step back, you would agree with me that the corporate earnings in the US have been robust this year. The Magnificent Seven earnings growth obviously slowed but remained very high, and the remaining S&P 493 have printed a positive earnings growth in the second quarter for the first time since 2022. Then the US GDP grew 3%, and yes, the jobs market in the US loosened, but not alarmingly so. So to me, today's Fed decision and the dot plot will actually give the market and investors an opportunity to readjust their expectations to a more reasonable dovish level, and a hawkish shift in Federal Reserve expectations could eventually lead to a rebound in the short-term US yields and the US dollar, and also weigh on equity valuations. But on the other hand, a jumbo rate cut from the Fed, necessary to meet the 100 basis point cut hurdle before the year ends, which is now completely possible, well, could trigger a relief rally, but is not necessarily the best outcome for medium to long term, as it would mean that the US economy is not doing fine enough for the Fed to take the beginning of its loosening easy. On the contrary, it would start with a panic. Therefore, I maintain my view that a 25 basis point cut would be the best possible outcome for the markets for today's Fed meeting, and it would mean that the Fed will just start cutting its interest rates when the growth figures in the US and corporate earnings from the US companies are still in a good shape, and the US jobs market is still healthy, though loosening. Now, what would be less pleasant is if the Fed shows any reluctance for back-to-back interest rate cuts today, which to me is no longer a risk, apparently. But what would be really the worst case scenario is if the Fed makes a mistake by cutting its interest rates by 50 basis points today and must correct its course in the future meetings. So this is all from me today. I'm now going to stop here and let the Fed announce their decision. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.